So, hey guys, welcome back to Accelerated Real Estate Investor. This is your host, Josh Cantwell, and I have a fantastic conversation with you today to share with you. I'm interviewing Zain Jaffer. He is the founder and CEO of PropTech VC. He was successful at growing and building his original company, which was called Vungle, which he sold for $780 million to Blackstone. Vungle was actually an advertising platform specifically for mobile devices that he built and sold to Blackstone for $780 million. Today, Zain is very passionate through his company called Bluefield Capital, very passionate for technology inside of real estate investments. So he's the host of the PropTech VC Podcast. He also invests in technology companies that specifically provide services to the real estate industry and specifically multifamily. And he also buys real estate across the United States through Bluefield Capital, runs his own family office called Zain Ventures. And he is a phenomenal guest. And we're going to talk today, number one, about his start in building his first original company. Number two, how he sold that business to Blackstone for $780 million. Number three, he's going to give us three specific technologies that he's using in his multifamily properties that helps him create more cash flow, offer less concessions, and increase the value of his properties, and make things more safe and easy for his team. So you're going to enjoy those three resources in particular. Zain also looks back at his entrepreneurial journey and everything that he's accomplished and tells us a couple things that he's really proud of. So you're going to love this interview with the CEO and founder of PropTech VC, Zain Jaffer. Here we go.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So Zain, listen, so excited to have you on Accelerated Investor. Thanks for carving out some time. How are you?
I'm doing great. Thanks for having me on the show.
Hey, listen, I'm always excited to talk to successful entrepreneurs and business owners, and especially in today's crazy economy, facing a possible upcoming recession, rising interest rates. You know, things are very, very different than they were just even 6 months ago. But there's great entrepreneurial stories happening all the time, regardless of the economy. So I'm excited to hear from your perspective what you're up to, what you see happening in the marketplace in the next 3 to 6 months, and some projects that you're working on that kind of gets you going. So what are you passionate for, Zain? How are you expecting to kind of operate in this environment? And what are you most excited about in this next kind of short term?
I wear many hats, and what I would say I do primarily is I buy real estate and I invest in startups that service the real estate segment.
Mm-hmm.
And both are so different and have been so different over the last 6 to 12 months and will be different over the next 6 to 12. On the real estate side, I'm part of a private equity firm, Bluefield Capital.
Mm-hmm.
Right? We have billions of dollars of real estate across multiple asset classes. We wrote 100 straight offers last year. And for some reason, like brokers didn't even get back to us. We weren't even the top 3 or 4.
So it doesn't matter if you have billions of dollars, they treat you the same as the rest of us, huh?
Exactly. And then recently we started to get called up by brokers and they're like, hey, remember that deal you bid it on? Well, the seller really liked you. It's just that, the other person had a higher offer, but there was no earnest money and had their retrading terms. Would like to revisit your offer, right? We're getting lots of that happening right now. And it's like, yes, this is the time to buy. We've been sitting on the sidelines trying to buy, and now I feel like it's a good opportunity. On the other hand, when it comes to startups and investing in technology companies, oh my God, the last 12 months were so heated, and I did a lot of deals, right? And I just had to deal with the fact that the market's the market. You have to pay a high valuation to invest in certain companies. Now it's just a bloodshed. You've got public stocks that are down 80% from the all-time highs. And that means you need to 5x your investment to make your money back. That's scary. So on the startup side, I'm seeing a lot of damage right now, and there isn't any calibration happening. What I mean by that is that probably how you have sellers who have unrealistic expectations, right? And you have buyers who are kind of in tune with mortgage rates. Well, in the startup ecosystem, things take a while to trickle down. When public markets, collapse, it flows through very slowly. And I'm still seeing many founders trying to raise at insane valuations, giving hyperbolic pitches about taking over the world. And on this side where I'm sitting, it doesn't fly anymore. It's like, wait, I'm not going to pay 100x forward revenues.
Right.
And valuations have changed as a result.
The market imploding, Bitcoin imploding is really what in the past 30 to 60 days, right? So things can just change that fast when the market's not as liquid and people are taking bloodbaths other places. And so what do you think will be happening now going forward? Obviously this recession is going to be a continued discussion probably for the next 18 months. And so what adjustments do you continue to make on those valuations? Because what's happened in the short term, probably only going to get worse now.
First I want to take a step back and talk about the last 6 months. And I have to say, it feels like every single asset class has been hit negatively, every asset class. You could leave your money under a mattress 6 months ago and it'd be worth maybe, 4% less if you take the 8% inflation, right? Or you could do what everyone did, take their money, put it in stocks. And now that, you took your money not to lose 8% and now you've lost 50%.
Right.
Crypto is down. Technology startups are down. Real estate is finally coming down on the commercial side. On the residential side, not so much. So I'm seeing a 10 to 15% decline there, not as significant, right? And more, a lot more panic selling now happening on the real estate side. Hedge funds have not been performing. Most of the hedge funds I've invested in through my family office are just giving me dismal returns. And it's like, wait, I don't get it. During the bull market, you guys didn't outperform. And now during a bear market, you guys are actually correlated returns. What is going on? So every asset class has been hit. So I think, the corporate Wall Street world and family offices, we're all suffering right now. Sure. It's sad to see what's happening. Now, on the valuation side, like I mentioned on real estate, I'm seeing 10 to 15% declines, and I'm getting that signal from multiple brokers and also just how we're bidding. It does affect the way we bid on projects, because before you could play around with some assumptions, and those assumptions were just people were making the spreadsheet fit the deal eventually.
Right.
Let me fine tune the interest rate. Let me fine tune the rent growth. Let me fine tune the cap rate compression, and let's just assume it's going to be cap rates will compress. Whoa! Right. Suddenly, if you just take a variable like your interest rates, that materially impacts cash flow focused investors. So real estate definitely going to get. Startups, I'm still seeing a disconnect. I'm here thinking, how am I seeing pitches where founders are raising on crazy terms? I'm not okay with that anymore. I can't just invest in an idea in a deck. If it's not a repeat founder, or it's not a very exciting area like Web3, if it's traditional PropTech, I'm seeing some founders that are very reasonable and realistic, and they're raising on terms that I can see myself making money on. Then I'm seeing others where it's like, why would I invest at a crazy valuation? I need to make a 10x minimum return. I'm not going to get that. So I think the multiples are going to start going down significantly, and it's going to be an amazing time to buy both real estate and invest in startups in real estate.
I love it. I definitely have seen the sheets, the decks, the pitches with ultra low interest rates, ultra low cap rates, and very high rent growth. And all those levers have moved, right? All in the opposite direction. And you got hit, interest rate higher, cap rate higher, rent growth not as high. And all of a sudden it's like, whoa, okay. You're talking about millions and millions and millions of dollars, especially on those deals in the Sun Belt that were trading at $250,000 a door, $400,000 a door. It's all going to come down. It has to, and you got to be smart about it. But you seem excited. Many people would be like, oh shit, like this is going to be rough. You seem excited though about the buying opportunity.
Well, you have to be. This is where money is made in situations like this. I remember when COVID struck, I was trying to be very aggressive, and we bought, we bought some things, but I felt that buying window was only there for 6 months max.
Mm-hmm.
And during that time, a lot of things happened. We had the rug pulled underneath us from mortgage lenders who were like, "Oh, wait, we need to slow down a little bit. We're trying to figure things out right now." And a lot of LPs also panicked and didn't want to, they wanted to just take a breather, see where things were. If you had cash at that time, you could make, all cash offers,
Right.
and you could get retrading of terms. And look, that's just a fact of business, like the market changes if we want to do this deal. So we did a bit of that and we got some good deals, but then everyone caught on to the secret.
Sure.
This time it feels different.
Yeah.
This time, I think we're waiting for, at this point of time that we're recording on, this podcast, right, on 19th of May, 2022, I think we're waiting for the market to reach its bottom.
Mm-hmm.
I think right now LPs want a breather. We run a fund and we're shy of calling capital right now. We don't really want to give a capital call to our LPs because our LPs are also probably struggling. They're like, okay, wait, what's happened? And a lot of people were doing something. Me too. I'm in this bucket. I had a lot of liquid securities that I was borrowing against at very low interest rates.
Sure.
And you're collateralizing your securities and you're buying real estate and you're playing arbitrage. You're borrowing at, I'll tell you, sub 1% interest rates for a while, right? You're investing in real estate that's generating you a 7-8% cash on cash, and it's a bit lower sometimes, right? You're playing arbitrage. Now suddenly you're like, whoa, I don't want a margin call, and I really don't want people calling capital from me because this is a period where I just want to see things stabilize.
Right.
I'm in the process of selling a lot of real estate right now, and believe me, I started to feel that heat. Brokers were telling me, this is my family office portfolio, not Bluefield, but brokers are telling me too, hey, the Fed's going to increase rates. And I'm like, whatever, like it's a great market out there. I want to hold out a little bit longer. Suddenly when that rate, increased, I'm like, hey, let's put everything on the market. I wasn't alone.
But as you know, like the market not only built in this first quarter point and a half point, but the market significantly overreacted with expecting significantly more interest rate hikes over the next 6 months. And then what I saw was, even perm financing jumped from 3.25 to 5. Now it's back down to about 4.5, right? But the market overreacted to all those interest rate bumps, has settled back down at 4.5. And then we're going to see what's going to happen now. But, the market typically reacts very quickly. The Federal Reserve reacts very slowly. And the market reacts before the Fed. So the market jumped and now it's settled. I'm excited to see, like, as deals come out. And we're really bullish on Ohio. I'm specifically investing in Ohio, especially because of the microchip stuff. Intel, Facebook just announced that they're going to put data centers in Dublin, Ohio, just outside of Columbus. The connection between Columbus, Dayton, Cincinnati is there. There's some really special economics there for this, what they're calling Silicon Heartland in Ohio. I would love that, but it's not as competitive or overbuilt or so much competition as the Sun Belt. But I have a feeling Ohio's going to have some legs because of the real economics. But it's been nice to see some people who are really kind of cowboys in the way they were making offers to hopefully get kind of knocked out of the market, right? I'm actually excited about the next 12 months of the people who are real operators that really know how to evaluate a deal and are patient and smart. Those are the guys that are going to win deals here in the next 12 months when a lot of people are going to run scared. What are your thoughts?
Absolutely. And, just yesterday we bought and we closed on a hotel in Dayton itself in Ohio, an 84-room hotel. And, it's just like markets like this that aren't necessarily mainstream, the T1 core markets, that's where the best, where the solid fundamentals, where there's a lot of employment diversity. In Dayton's case, there's lots of, manufacturing not so far away. You've got really strong fundamentals. And population growth, that's where the money can be made big time. And that's where I've tried to focus too. But I'm very excited because I think our approach has been, we try to find markets also where there hasn't been too much institutional heat. Mm-hmm. So we can come in more where there's a lot of mom and pop owners, and we can sort of consolidate and come in at that $10 to $50 million acquisition range.
Yes.
And be a serious buyer in town, right? So we've identified a few core markets, and it feels like this is the best point now because mom and pop owners are getting a little bit nervous because they're seeing like, okay, we were holding out, like I was holding out for some of my properties, holding out. Oh crap, interest rates are increasing, buyers might run dry. We people in real estate who are conservative really start to gravitate towards the fear, not greed anymore, right?
Yeah.
So we're excited because we can buy. We have dry powder sitting on the sidelines. We do a unique model too. We have a fund that we buy real estate from, via Bluefield, but we also put a portion of the capital stack through syndication. We'll offer it out to LPs. That's where I'm seeing a little bit of struggle now. It's like, wow, folks who are very happy to write $1 million or, a $500,000 check are like taking time now.
Yeah.
It's like, this is the time to be aggressive.
Investor, right? Most of them are just reading the news, seeing their accounts go up and thinking that they're geniuses.
Yes.
Now they're like, oh shit, I'm not really a genius. Because I had one investor, Zain, you'll appreciate this. Guy has about $1 million with us, and he starts to pull some money off the table because he's quote unquote playing the market, and he's having success with it for the last 18 months. And then all of a sudden he's like, yeah, I think I'm just going to pull it out and keep playing the market. And then that was 60 days ago. Now he calls me back just a few days ago. It's like, yeah, those 6, 8, 10% prefs, those were really, really good that you were paying me. I'm like, yeah. Like that's the stuff, like apartments, as people, if they're not aware, apartments, multifamily, especially suburban C and B class, they did really well in the crash of 08, 9, 10, right? Depending on where you get your information, they might have dropped in value, maybe 8 to 11%. And so as this continues to happen, because the single family market is so tight and there's no supply, these people have to live somewhere. So it's just one of those kind of backbone of your portfolio positions. That's just something smart to invest in. Again, not in those gateway markets, the Chicagos, the San Franciscos, the Dallas Fort Worth, but those B-class secondary, tertiary markets. That's my favorite. I love it. Zain, listen, I know you're busy. I know you have a limited amount of time. I want to hear more about PropTech, and I want to hear more about what's happening with the technology world that you have so much insight into, that is helping people be better operators, better evaluators of real estate. What's happening in that space that is revolutionizing the way people invest in and manage real estate?
Every asset class was impacted through COVID. And what I felt happened is that the real estate industry has been very slow to adopt technology.
Very slow.
Everything is run on spreadsheets, and everything, you ask any fund how they differentiate, you hear the same, can I say, nonsense. We have relationships. We've known this broker for so long. We've worked with this construction for so long.
My spreadsheet's better than yours.
None of this is sustainable as a competitive advantage, right? You're going to be disrupted by the Blackstones of this world as they, automate what they do. And so PropTech is basically selling technology to the real estate sector. And when COVID hit, the entire office sector, the entire retail sector and hospitality sector and the industrial supply chain sector, boom, right? Suddenly they now need to look at technology to reinvent the way they operate. And surprise, surprise, wait, who would have thought having contactless check-in solutions or smart locks would suddenly improve your cost and allow you to print more money and NOI? And so what I love about PropTech is that many of the technologies hit the bottom line. And if you can show a real estate fund manager that I can improve your net operating income, this technology provides an ROI, you spend X and you save X, or you make more, that's valuation that you capture. Given cap rates, a small saving can result in a huge increase in value. So that's what PropTech is, investing in any technology that the real estate sector can use.
Got it. Give me some of your favorites. So I own, 3,000 units. I'm an active operator.
Yeah.
We syndicate, but we tend to keep about 60 to 70% of the equity for us as GPs. We give up, 20 to 40% to LPs. So we have a very nice and healthy balance sheet. And I'm always looking for new ideas and opportunities to increase our NOI and make things smoother and easier. So you're looking at, Wi-Fi access, keyless entry, some of these types of things. What are some of your favorites that maybe you've invested in, or some of the things that you're looking at that you think will, from the technology space, impact your personal portfolio?
It's like asking me to choose my favorite child. And here I got 30.
Give me a couple. Well, pick 2 or 3.
I'll pick 2 or 3. Okay. I'll give you some really quick, easy ones. Okay. Deep Sentinel, founded by the former co-founder of Redfin. It's a really, hot entrepreneur. I've implemented this in my portfolio. I have some Class C workforce housing where there's been a lot of crime. I've had people murdered on site, literally that type of place. Okay.
happens.
And we looked at security personnel costs, tens of thousands a month, and they want armed guards and they want 2 people at least, right? Generic traditional security systems are useless because they, you have to make sure you record properly, they don't store very long, and they're not actively monitored. What Deep Sentinel does is this camera with live monitoring. Like there's imagine somewhere around the world, there's a group of people looking at the screen. And when the AI or the human notices something that isn't right, they're able to communicate through the camera and say, excuse me, can I help you? You're trespassing. And as word gets around and residents know we're being monitored, right? And we've caught crime happen. And that person is able to call the police for you. They're not just able to tell you, oh my God, something's happening. They'll call the police proactively and say, we're calling the police. You need to evacuate immediately. You're trespassing. Crime is completely stopped. And that solution was very, very low cost, right? So that's Deep Sentinel. Another one I really like, and I'll talk about workforce housing because I've really, I've enjoyed that. It's been tough. Stake.rent. That's a company that provides cash back to tenants. The idea is rather than offering concessions, like here's 4 weeks worth of rent for free if you sign the lease now, tenants don't appreciate that.
Right.
Instead, hey, if you sign the rent now, we'll give you $200 into your account. And you know what? You can have a bank account with Stake. You can have a debit card with Stake. And as you pay your rent on time, you can unlock more and more. We've reduced our delinquencies. We've increased, a cash collection, obviously. We've managed to get rid of concessions in many of our properties by having Stake there. So Stake is wonderful.
Wow, love it.
And another one that's really good for folks who self-manage is Canopy Analytics. I'm on the board of that company, so I want to disclose that. I'm an investor in all these companies, so I should disclose that too, obviously, right? But what I found that Canopy does that's really cool is I can see my entire portfolio and all the on-site staff, the asset management team, the executive team can communicate on there, and they can see okay, let's zoom in. Let's see the reporting for this specific property. I can leave a comment. Okay, there's an insurance claim. They need my approval. I've been assigned a task. It's just an operating system for managing your entire portfolio. And I think owner-operators really need that. And if you have third-party managers, you appreciate the pain. You're overloaded with emails and reporting, if you're lucky to get reporting consistently too. And if you have multiple third-party managers, it's a nightmare. So Canopy sort of consolidates that. Right now, mainly focused on owner-operators, but they are building a solution now also for third-party, fee managers. So just 3 I could quickly think of.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
And the first one that you mentioned, right? So I have a C-class property, and sure enough, about a year ago, we got some video. Again, the video wasn't that great. It's very grainy. Some guy makes his way into one of the garages, and all of a sudden there's just this poof of fire that comes out of the garage. Right after he walked out, the guy lit fire 2:30 in the morning on a Wednesday. He lit fire to the garage for no reason. And so it ended up taking down 5 of the garages. The garages burned to the ground. The fire department has to be called. Sure enough, he hit another complex. This is a little complex I own, an 80 unit. He hit a 300 unit the same night down across the street. And if that monitoring had been there, of course, he picked the garage in the back with the least amount of lighting, and that ended up being a $350,000 insurance claim. And those are being rebuilt right now. We finally, finalized the scope of work and all that stuff with the insurance company. So, real application there, guys, right? Of how to use some of this technology to make your building safer, collections better. I love it, Zain. Appreciate those couple of inputs there.
Well, just to add there, right? For all the folks starting out in real estate, it's very easy to think, well, this is just a 12-unit building I'm buying or a fourplex, right? But if you want to be in this game long-term, you have to take a portfolio approach. Just that example you mentioned of this, what you would say tail type of activity where you've got a crazy guy who's an arsonist. That's going to happen in a population. When you have hundreds of people, 1 or 2% of the population does have some problems. They can be criminals, they can be, lunatics. When you grow your business to thousands of people, you are going to every day be dealing with some type of insurance claim. So you better make it your business now when you're starting out to implement the infrastructure and technology. Because, you may get unlucky and get hit on your 12 unit, but I guarantee you, when you've got 3,000 units in your portfolio, you're going to have stories to tell. And your goal is to get to tens of thousands, obviously, hundreds of thousands of units one day. You better make sure, and not you, but the listeners, right? Like invest in the fact that outlier events will happen, make it a core competence to understand how insurance works and security works, and just run things professionally, because you will get hit one day. And when that happens, you want to be able to bounce back quickly.
No doubt. I tell my group all the time, look, you have to act as if you have a 10,000 unit portfolio, even if you don't yet, right? The only way you're going to have a 10,000 unit portfolio is if you act as if you have it now, and eventually you'll just get there. It's only a matter of time, but it starts up here in the mind. And if you're constantly telling yourself, well, I don't really need to do that yet, there's going to be a time in the future that you need to do it. And you're going to think, oh crap, I should have done that 3, 4, 5 years ago. So act as if now, and then those, chaotic moments, they won't take your business out. Zain, I am interested to hear, you came to this country, started your first company at 14, later moved to the US as an immigrant. You've had unbelievable success in building this family office. Tell me about the original start. Where did you know that you had this entrepreneurial bug? Where did you know that real estate and technology was the path that you'd head down?
Yeah, I was born in the UK, but my parents are immigrants, and grew up in a poor neighborhood. And so I was able to stay out of trouble by just playing around with computers, and I just kept building websites. My voice broke quite early. So, puberty hit early. So I was able to pick up the yellow pages and call companies and convince them they need a website. Of course, horror would strike when they wanted to meet face to face. I'd have to come up with every excuse possible and instead just start designing the product and send it to them. Look, here's your website. Do you want to pay me? They'd be like, okay. So I did that for a while. And I just always had this knack. I grew up in the time where, websites were a thing. And then my biggest success was when applications started to become a thing as well. And I had the idea, let me build a niche. Let me build an advertising company that shows ads on smartphones. And at that time, right, people were dealing with farting apps and flashlight apps. People didn't understand why you would do such a thing. But I saw that apps are going to change the way we operate. And so I built my company there, and it was a major exit, $780 million acquisition. And after that, after not taking a salary for so many years, I just wanted to jump onto the other side, which is real estate. I'd see people, and can I say, half the people in real estate are idiots. And that's why it's so easy to make money, right? The other half they're doing, the other half are very intelligent, and there's information asymmetry. But I'd see folks make stupid decisions, that buy something, use crazy leverage. They would even screw up the project, and yet they'd be able to sell it for a lot more, and they'd be getting, they'd be able to do 1031 exchanges and get cash flow. And I was like, I need to understand this. And also, real estate is always a key part of people's portfolios when they reach a certain net worth. Sure. So I felt like, look, through my family office, I want to actively get expertise in real estate. And it's a $300 trillion asset class. There is no asset class in the world that compares to that. The global value of currencies is only, measured in the single-digit trillions, right? So you're dealing with hundreds of trillions of dollars. It's very exciting.
Unbelievable. Zain, hang on one sec. This is ringing, so bear with me. I'm going to edit this part out. Hang on. Actually, that's a phone call I need to return. That's one of the biggest brokers in Columbus calling me back. I'll call him when we're done. So let me, I'll time back in. And what I'm going to do, Zain, is I'll ask you the final question about advice. So I'm going to count this down, 3, 2, 1, and then I'll ask you about that. Okay. Hang on one second. Okay, cool. All right, here we go. 3, 2, 1. So Zain, now that you've added, real estate to your portfolio through this massive exit, and you've had the opportunity to be on the technology side, start young, see the benefits that real estate offers, looking back at your path, right, over the path of entrepreneurship, starting at a very young age, being an immigrant, I'm always curious to see someone who's really made it, right, start from zero and really make it. What would they do different, right? Or what did they think they got right? So I'm curious to hear maybe one or two things that in your path you'd look back and say, you know what, if I could do it over, I would do this differently. And one or two things that you say, you know what, I absolutely did this right. I made these correct decisions, and that'll help our audience, with their entrepreneurial path. So what are your thoughts on those two?
I would say the way I ran my company and the decisions I made, I operated with a lot of integrity. I saw competitors get away doing things that really were illegal at the time, and they were unethical. And we lost a lot of potential sales and revenue because we did things the right way. And I always believed in under-promising, over-delivering. I never wanted to take any money from investors, even now that I run my fund, unless I'm sure, I'm going to do them right and I'm going to make them money and I'm going to 100% focus on this. And so always manage expectations, under promise, over deliver, and do things the right way. Because if you want to stick around long term, word gets around fast and you can make a quick buck, you can screw someone over. But the real estate sector, the technology sector, they're tiny places. It's an echo chamber. And the world catches back up with you. So that's the hard thing that I did. And at times I felt like, man, I could just do this to juice revenues, but I didn't. And long term, it worked. We lost clients because our competitors were offering, and not just unethical stuff. Like, we maintain gross margins. I really believe in maintaining gross margins when you run a company.
Wow.
We had really high margins in the 40% range.
Wow.
Just for showing an ad, if an advertiser paid us $1 million, we'd keep 400,000 for ourselves. And we'd give 60% to the website or the app that showed it. Competitors came in when we were offering 100% rev shares or 80% rev shares. Of course, we'd lose clients. They'd say, hey, you guys are taking so much. And I'd be like, I know we are, but we have a business to run and you shouldn't be upset about us taking our fee because the absolute dollar will be higher. But go ahead and work with these other companies if you want. And guess what? Many of those companies went bankrupt. Reinvest our margin back into building a better product. And it's the same with a broker. Brokers always reduce your fee. You should be happy to pay that broker a fee. You shouldn't really go incentivize them because they're going to make you big bucks. Absolutely. And I think once people start to realize they try to do it themselves or they try to, negotiate on cost, you've got to feed everyone around you and everyone wins. You want to be paying large tax bills. That's a sign of success. You want to be paying huge commissions to your salesperson. You want your salesperson to be earning millions of bucks a year because that means you did something well. So I think going down that view of making sure everyone wins when they work with you is definitely what I did right. And, my early employees are millionaires as a result.
Yeah.
That's what I did right, I'd say.
That's fantastic stuff. Sounds like the word that kind of resonates in my mind as you're talking is you played the long game, the infinite game, right? I'm going to play the game to be in business long term. I need to make a large gross margin to do that. I'm not going to shortcut it just to acquire a client for today's revenue or next quarter's revenue. We're going to focus on the long term, paying brokers, again, long-term infinite game play. Those are the things that are different for somebody that, and guys, listen, it's okay, like Zain said, to not make as much money today, to be in business forever, right? Would you rather be in business forever and make money forever and make a little bit less money today? It's okay to do that, right? To pay someone else big money, to pay your salespeople, to pay a broker, to pay someone on your team large commissions, so that you ensure the lifeblood of your business for a long time, that your family gets paid and their families get paid, and you take care of these people. Playing the infinite game can be very difficult when you're in startup phase, but it has to be something that's on your mind. That's on my mind all the time, Zain. I love the fact that you brought that up. It's a big cornerstone of what we do as well.
Thank you so much.
Zain, listen, I'm sure our audience is going to want to learn more about you, connect with you. Obviously, just tell them a couple websites, social media places, platforms that they can learn more about you and follow you in your journey.
Yeah, I have a platform called PropTech VC. You can reach me on zain@proptechvc.com, and you can read some of the stuff I'm up to on there.
Fantastic stuff, Zain. Listen, thanks so much for joining us today on Accelerated Investor.
Thank you so much for having me on.
Well, there you have it, guys. Listen, Zain is just an absolute, just behemoth investor. He's an absolutely great guy. And I look forward to getting to know and spend some more time with him off of this podcast. If you enjoyed the episode, make sure you open up your phone right now, leave us a 5-star rating and a review, and tell us how we did. I would be so grateful to hear your response, your feedback on this podcast, on the show, about the guests that we're having. It would mean so much to me if you would share this episode all over social media. all over your Facebook, your Instagram, your LinkedIn, and help us continue to build the accelerated investor community. Thank you so much for being here today on AI. We'll talk to you next time. Take care.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.